go into more detail, or one bit I'll check it actually applies to you guys, if whether we need to discuss it or not, and then we'll go from there. So really, the tax reliefs that we can claim now, I wanted to discuss capital allowances and what's available there, what's been changing, and then moving on to what actually qualifies for capital, or what we could manage to get under the banner of repair. Then, I don't know if this will apply to anybody. Is anybody trading as a company?
No.
If we were trading as companies, there's research and development tax relief, but we might not need to touch on that if no one is a company here. And then the tax relief in the future on retirement, is the structure of your business correct? Have you thought about how you're going to secure that lower tax rates that are available at the moment? And then obviously, if you're not planning on retirement, which a lot of farmers don't, they gift away on death, have you got the structure right there? Have you got allowances available for all your assets, even if you've diversified? And if that's something that we need to look at further. So that's really what I was going to do. So I'll just go back and I'll give you a brief overview on the capital allowances front, on what is from my perspective, what people are missing out on mainly at the moment. The capital allowance is available to all trading businesses. We're all aware of the allowances we can get on plant and machinery, which is the annual investment allowance, which is 100%. That's nothing new, you know, we get them on tractors and trailers, etc. But what is being missed is the allowances on integral features. And there was recent case law last summer, which had a grain shed in this instance, which had special features, and we were able to class it as plant and machinery. So basically we said the whole shed in its entirety was allowable for tax. Well, that was a massive shift from what we've got now, because everyone previously knew that sheds, you just did not get capital allowances. It was a capital spend with no tax breaks. So the shed case, as I refer to it, it's actually brought us a lot of tax savings, going back and amending things in previous tax computations for clients. The other one is renewables. If anybody has any renewable enterprises on their farms, and if they provide private use, so I'm guessing your current accounts or yourselves would have claimed 100% allowances on any renewable assets you would have bought. But for instance, if that's a biomass boiler and you're supplying the house with heating, or let properties with heating, you may be in for a nasty shock if you haven't accounted for that private use in some way for capital allowances and for VAT. There's been several cases where the tax man has said, no, that's not wholly and exclusively for business. You're also using that for personal heat or let property heat, and they do not allow the VAT and they do not allow the allowances. So there is ways around that to make sure you can get those reliefs, but it's just something to be aware of and something you should be flagging up to avoid a nasty surprise. The rest of the capital allowances are in areas of diversification. So if anybody has any furnished holiday lets on their holding, or commercial rental spaces, or other holiday accommodation, there may be allowances available on those. For instance, if you've got a furnished holiday let, which you have started letting out on a short-term basis, as long as you tick the boxes to get the holiday let criteria, which is available 210 days of the year, and it has to be used 105 days. If you can tick those boxes, you can do a capital allowances claim. You don't have to have the invoices from the property. You can get, we've done instances before when we went into the property with a quantitative surveyor, and even things as far as the light switches, the radiators, kitchen units, they're all plant machinery and they can all be claimed against your tax bills. That's a common one that's quite often missed. and can be massive in terms of tax savings. The other point is, if you have diversified, are you running those businesses through the farm? Could you set up a separate structure and get a better benefit? For instance, are you doing bed and breakfast, or are you doing holiday lets? If you're doing them through the farm, I'm almost certain your farm will be VAT registered. So they are VATable supplies. So if you are doing that through your farm, you are suffering 20% VAT. Whereas if you did a separate sole trade or a separate partnership, which was slightly different to the one you're trading from, you may immediately save that 20%, which is a massive thing that could be missed.
Victoria, is that why we often see that where there are farm businesses with bed and breakfast and holiday lets, that the B&B is a separate business often run by the farmer's wife? Or...
Yeah, so that follows the entity. So if husband and wife have a partnership, that is what's registered for that. It's not you as an individual. So if the wife was doing a B&B, she would have a sole trade bed and breakfast business, and then she would be a partner in the farm, whereas the bed and breakfast would be not registered.
Yeah.
Wouldn't want to suffer that 20%. So that's capital allowances in a nutshell, just really the points that I think are really on topic and what's being missed just now. If anyone has any questions on those or would like me to expand on anything further, I'm happy to, or I will move on.
No questions at the minute.
Great.
No.
So moving on to tax reliefs in the future. So on retirement, let's hope we all retire. The main point that I would be pointing out to you is, what is the structure of your business? Have you got your assets on your farm balance sheet? Do you know who owns what? I know in a tenant farm, obviously there's not the land and buildings in ownership. But do you know who owns what? That's a massive thing with farming families, with businesses that have went on for some time, that people don't actually know the true ownership of their assets. What we're trying to achieve on a retirement situation would be entrepreneur's relief, which is the lowest rate of tax applicable at 10%. Now, this replaced retirement relief, which was changed, let's say, I think like 5 years ago, into entrepreneur's relief. It doesn't fit farming very well at all. It's been made to fit corporate structures, and it's quite tricky to get the relief as a farming business. However, it's not to say that we can't get it, and we've successfully got it in lots of cases. So what that means is capital gains tax on the sale of your assets at 10% rather than 20%. However, there is a lifetime limit on there of £1 million, of which, when it comes to farmland, that's not a lot of money. You know, most farms are in excess of this. That's discussing the assets itself. Where it comes to the stock, have you thought about this previously? Do you have a herd basis election in place? So that means your herd or your flock, the assets which you have been trading from, so the core of your business, you can sell them tax-free on any uplift in value, but you have to have the election in place. And has your election been updated? So what we see time and time again is mum and dad started farming, they had a farm herd election, they bring in the son. Strictly speaking, that election needs updated. And if it hasn't been, will the revenue recognise that you have one in place? If you haven't got one in place, there is times when you can make changes in your business structure to bring it in. And is that something you should be looking at doing now? The other further on to that is gifts and gift holdover relief. So at the moment, agricultural assets can be gifted, claiming gift holdover. with no capital gains tax. So what that means is 100% of the gain is carried over. And let's say you gift it to your son, an asset that you paid £1,000 for, he gets it tax-free from you, and his base cost is now that £1,000. That's something that is currently available to us, but has been mooted in various tax papers that will be removed, the gift relief option. So that's, in a snapshot, the reliefs available on retirement. Would anybody like to ask any questions on that before I move on to the agricultural property relief and business property relief on a death situation?
On the flock basis,
Yes.
does it have to be a one-off sale of your breeding stock, or
It has to,
you can't do it gradually?
you have to do it in increments of at least 20%.
Right.
So if you were to sell 20% of your sheep, and you can't go back up in number within 5 years, but if you're retiring, you're not going to do that anyways. But if you sold 20% 1 year, another 20% next year, that would qualify. But it has to be 20% minimum.
Right, and that could be over 5 years.
Yes, it could, yeah. Obviously, that's to give you the chance. People appreciate it is difficult to do a full dispersal in one on times. So yes, as long as it's 20%, they qualify. Selling 5%, or you know, a bull now and no other animals, that doesn't qualify.
Right. Okay.
Will holdover relief, will the CGT have to be at some point? Yes, that was just a question that flagged up there. So with gift holdover relief, the CGT only needs paid when the asset is ultimately sold. So you can carry you can carry the gain over, is what it's referred to, and the actual gain comes into charge, and the tax is due when it is sold. So the sale triggers any tax that is payable. Oh, you're
I know. Should know better after all these months. Yeah, if anybody wants to type in a question on chat, please do so, which is what Andy did just then, or feel free to butt in, or you can even raise a hand as well. So thanks for spotting that, Victoria. You beat me to it.
There was another one there as well.
Yeah, I answered the one earlier. Just Louise was just asking if we can have some information, you know, sort of a summary at the end of it, and we'll email that round along with the information you gave me earlier, if that's okay.
On what value is the CGT calculated? That was Dyer just said that.
Yeah.
CGT is calculated, so if it's a gift, well, if it's the market value, it's the sales price. So if you've sold the asset, it is the difference between the selling price and the cost. Whether it be the cost to you, or the cost when you bought it, or the cost if you've held it over, it's the cost of the person who gifted it to you when they bought it.
Mute again. Question from Tessa saying, with regard to gifting to a son or daughter, is there a length of time the individual gifting needs to live?
Well, any gift comes, it's called potentially exempt transfer. So yes, 7 years is the time we all know that you have to live. However, when it comes to agricultural assets, if it was a qualifying asset at the time of gift, it would still be qualifying on death. So if you gifted it and it was, let's say, a field qualifying for 100% agricultural property relief, it wouldn't trigger any capital gains tax, so you'd hold over the gain, and there would be no charge on death because it would already qualify for agricultural property relief. So on the assets that qualify, it's for the relief on death, the 7-year thing isn't a problem.
Okay, thank you, Tessa.
That leads us on to, if there's no questions on that one, the position on death. So basically on death, we've got 2 reliefs for our farming and business assets, which is agricultural property relief and business property relief. As I touched on before, a massive thing with claiming the reliefs is who owns what assets and what is the business structure. That comes down to what we have in the accounts, what's said on the title deeds. Quite often somebody, a husband and wife situation, for instance, and the husband and wife say, oh, we own everything 50-50, when they don't. The husband owns everything in his own name. It's just, now is the time when everyone's alive to get that sorted out, get the structure looked at, suss out who owns everything, and that will just save so much time and problems when the time comes that somebody does pass away. A big thing that causes problems is who lives in the farmhouse on the farm. So in order for that house to qualify as a farmhouse and get the relief of 100% agricultural property relief, it needs to be the active farmer in there. It can't be the retired farmer who stopped farming, God forbid, let's say is ill, has dementia, isn't physically possible that he could farm. That will not qualify for relief when he dies. Awful as it sounds, the farmer needs to be in there, and the retired farmer needs to be moved out. It's not that saying the old granddad who's still fit and able, he doesn't have to move out if he can prove he has helped and he is part of that farming business. So he could still be a partner in that farming business, albeit with little input. But his guidance and his advice is still very much saying he's actively involved in the running. That is fine, as long as we can prove that. The problem is when we can't prove that, and there's a little case law goes back as long as my arm, where the farmer's in a care home or something and the farmhouse then just does not qualify. So that's a big one. It could be dependent on the size of the farmhouse. That could be a massive relief.
Victoria, is there an active farmer test, or is it really just on a case-by-case basis that a farmer and their accountant would have to prove those circumstances?
Well, the main one, is if he has retired and he's completely came out of the partnership. In that case, don't bring granddad out of the partnership if he is still in that house. If he still wants to live in the house and he's not going to move and he's still mentally fit, even if he's not physically fit, if you can do something as, proven, a great one is minutes of meetings. No one probably takes minutes of meetings, but let's say you said, we had a meeting every morning around the breakfast table in that farmhouse and he was involved. That would be fine. If the records are kept in that farmhouse and he still has input into the cattle passports, for instance, all that helps. But if the records aren't in there, there's no meetings in there, he's not helping, it's going to be a tough call to sell that one to the Capital Taxes Office on death. The next big point, which people don't realise, is have you diversified on your farm? And when I say diversified, it could be as simple as, do you let out cottages? Those cottages in years gone by would have all previously been farm workers' cottages. Do you now let them out? And do you now get a rent in from them? If so, that is no longer a business asset. That is seen as an investment asset, which isn't farming, it isn't agriculture, and it doesn't qualify for agricultural property relief. So those cottages could be fully chargeable to inheritance tax at the 40%. Now, there is ways around this. There is a few cases that came out about 8 to 10 years ago. If you can sell to the revenue that your business is operating as a business unit, so those cottages are on your farm, they are needed, that income is needed to keep your farm going, that could qualify for business property relief. So we know they don't qualify for agricultural, but we could still say it is business, and we still could get those fully exempted. But again, it comes down to the presentation in the accounts, what is physically on those accounts in terms of the balance sheet assets on what is shown as income. If your farm is making losses, so if your farm never makes a profit or makes very little profit, and you have 5 let cottages which are bringing in 50 grand a year, you're actually not trading as such. Your pure profit is coming from your investment in those cottages. I mean, if you're then using that money to put back on the farm and keep it going, there's something that could be done there in terms of presentation of those accounts. But it is something that definitely needs looked at if you're sat at home thinking your cottages are fully relievable, because they are not, unfortunately. So, and again, other business assets, such as if you have got wind farm rental, and it is just wind farm rental. It's not, you don't own the turbines. Power or another is renting that land from you. Have you changed those bits of ground into an investment plot? Is that land no longer farmed? In those cases, we can usually get around it because we're still grazing them. They're not fenced off, for instance, but if they were, or roads that they have, access routes that they have put in, have we got a problem there? And again, a lot of the times we can get around it, but if you're not aware of it and there are questions asked too late, there's no way of then window dressing your accounts to make sure it's going to tick the boxes for the Capital Taxes Office. So that was the main points I was going to touch on. If anyone's got any other questions.
Yeah, Victoria, there's a question in here on the chat saying, what is Victoria's view on the length of time that APR and BPR are going to be available at current rates to farmers, given that future governments may decide to look very closely at this tax break in the future? Have you got a crystal ball, Victoria?
Well, I actually sit on the committee for the SLE and the CLA, which is, for those who don't know, it's they lobby across Scotland and England, and they have party to the discussions that go on with the Treasury, etc. And I sat in a meeting, it was 2 weeks ago now, with the Office of Tax Simplification, and we asked that question. It was actually a capital gains tax meeting, but we asked a question about rates and reliefs. And they obviously weren't going to be telling us exactly what's going to happen, but they did say that there will be a massive shake-up in taxation given what's happened, and we are to expect changes. So personally, I don't think they will remove agricultural property relief or business property relief, but I think they may take away gift relief, and I think they may make it tighter on what you can claim. So I don't know everyone's position here, and if you're all very much hands-on farmers, but if you're not, I think you're the ones that might get attacked first. What I mean by that is, if you're letting, grazing, letting fields out for grazing, for instance, who knows what the view of that would be if the reliefs has changed.
That's interesting. Yeah, I hope that answers your question, Andy. I'm sure it does. Any more questions for Victoria? Any other comments about farm tax or anything like that? No. Well, that's good. Victoria, have you anything else to discuss with us? Anything else you want to touch on?
There's no point speaking about research and development relief because there's no companies on. So unless you're a company, I'm afraid we can't claim that one.
You could maybe give us a very brief 30-second overview of what that is, because it is quite interesting. If anybody was, if you know anybody who farms as a limited company, we don't have many members that are limited companies, but there are one or two.
Yeah. So research and development tax relief. People think this is a relief only available scientists with white coats, and it's really not the case. We've had a really good success rate, and done a lot of claims for nearly all of our farmers actually with research and development. And it's basically in areas, there's 3 things that you need to be doing. Well, one of 3 things you need to be doing to qualify. You need to be doing advancement on science and technology, an appreciable improvement in your field, or solving a trade secret. And to be honest, the solving the trade secret, that's something that farmers are doing every day without even knowing it. So you're constantly problem solving. And what you do into problem solve is you're basically trial and error testing to solve that problem. You can't Google the answer to how do I stop lameness in my sheep? Well, you can, but it won't work because it won't stop your sheep from being lame. So you might try and, I've got one farmer who we do a claim for. He has different methods of trying to combat that lameness. And it's the time spent doing that work and trial and error testing it. There's loads and loads of things, dairy, poultry, every kind of farming. I could probably have a chat with you and open your eyes to what you could claim on. In terms of figures, it can be massive. We've got a dairy farm up Scotland, and we managed to get about 80k back over 2 years tax relief, which they didn't think they would qualify for. And it doesn't even need, you don't even need to be profit making. You can make a loss and you can claim the relief and you cash in the loss and the revenue pay you for your loss, believe it or not. So it is really, really useful, and we're doing lots and lots of them, because it just seems a shame not to take advantage of it whilst it's there. And I don't actually think the revenue will stop it, because it's what they need to keep industries going. So they need people to be the best in this country. Otherwise, we wouldn't have the industries there. So that's just a brief overview. If anybody is interested, I have help sheets. I have lots of things on agricultural and research and development claims that I can send on.
Brilliant, thank you. We've got one question in on chat from Louise saying, when doing accounts and VAT, we usually put 80% to the farm on energy bills and 20% to the home. Do you think this is about right, Victoria?
Yeah, it's probably okay. So is that, in terms of what you're claiming relief on, are you not claiming relief on 20%?
I'll have to give her a little time to type on that one.
And is the 20% for the farmhouse, not claiming?
That's it. She said not claiming on the 20%. Yeah.
And is that's VAT? You're not claiming VAT on the 20%? When it comes to VAT, you normally would say you can claim up to 70% of the private element. It's a bizarre one. So you can't, when it comes to farmhouse expenses, you're allowed 1/3. So if your farmhouse electric is £100, you're allowed 2/3 aren't allowable, 1/3 is allowable. So you would be allowed £30 against your tax in your accounts. But 70% of the private VAT is allowable. So on electric is a 5%. So, it would be tiny, because you're 100% bill, 5% VAT, which is £5, you'd be allowed 70% of that £5.
Yeah.
It's a weird one. It's that the 70% is allowable. It's a strange one, and I don't know why that is the case, but that's what it is.
Hopefully that answers your question, Louise. Does anybody else have any more questions before we go? As I said at the start, we try and keep these sessions short and sharp at lunchtime. So any final thoughts for Victoria? Any last things before we say goodbye? Okay, well, look, I really hope this session's been of use to everybody. Please don't take offence at this, Victoria. We know tax isn't the most scintillating of subjects, but it's clearly so important to farm businesses, and having that right advice is clearly essential in the future, as managing farm costs is going to become just more and more important in future. I'd like to say a big thank you to Victoria. Nothing you've asked her has phased her at all. She's had the answer straight away. Clearly she knows her stuff. So we're really, really grateful for you for taking the time to join us today, Victoria. Thank you very much. If any of you have any questions coming out of this that you'd like Victoria to tackle, please do feel free to get in touch with her. I'm going to send you some stuff by email, some contact details. Likewise, if this gives you food for thought for your own, to work with your own accountants as well, please take that away. This is what we do in the Farmer Network. We're just here to try and help you and support you wherever we can. So, Victoria, thank you very much.
Welcome.
Thank you.
Hopefully we'll see you again for more subjects in the future. And yeah, keep watching, everybody, because we're going to do more of these short, sharp sessions on all sorts of different topics in the future. And we'd love to have your company again. So thank you very much, everybody. Have a great day.
Bye-bye.
Bye.
Everyone.